Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in yesterday's video we talked about VYM, which is a Vanguard high dividend ETF that has done absolutely amazing returns in the last 24-25 years. And what we did was the ETF itself is not a Shariah compliant, but what we did was look at the Shariah compliant in basically companies within that ETF, and then we basically talked about them, and then I've given you at the end of the video the back tested how much basically the total return for that ETF was for the 24 years. In today's video we will do slightly something different, and if I just remind you basically what we did yesterday, VYM, if you haven't seen that video, by the way, go and watch it. Slightly long video, but it's definitely worth watching it. So VYM is, like I said, Vanguard high dividend yield ETF, and it has a 0.06 expense ratio. It has 2.64 dividend yield. And I said to you guys yesterday, I promise you, if this ETF was Sharia compliant and 100%, I would be absolutely putting probably 30, 40, 50% of my portfolio in this ETF and leave it alone, because that yield is really good. The expense ratio is very, very low, and the returns were absolutely amazing for that ETF. So go and watch that video if you haven't seen it. What we want to do today is compare that with this ETF. Okay, this is SCHD. You probably heard about, a lot of YouTubers talking about this. A lot of dividend investors in this world love this ETF. Okay, and what I'm going to show you, what I found something slightly shocking. And now this ETF of course has not had the same basically stocks over the last 24 years, but more or less if you bought it and hold it for that 24 years, okay, where would your total returns be? And that is the surprise I'm going to show you at the end of the video. Now, as you can see here, it has more or less, well, exactly the same total expense ratio, 0.06, which is really good. And it tells you here the fund basically serves as a part of a core complement in a diversified portfolio. Tracks an index focused on the quality and sustainable dividends. So that's the thing, quality and sustainable dividends. So they are looking at dividend growers and so on. Invests in stocks selected for fundamental strength relative to its peers based on the financial ratios. So what I'm going to do now is I'm going to give you everything. Basically the 10 stocks, 1 or 2 stocks were from the yesterday's list, but I'll share that with you again, but majority of them are slightly different. So I'll go through all the companies first, but before we do that, as always, it genuinely takes a lot of time and effort. I'm basically putting these videos together. It takes a lot of time and effort, and then recording it, and then editing it, and then of course sharing with you guys. So I would genuinely appreciate, okay, if you can join us in the Patreon account. You do have access to the family portfolio. You've got access to all the buy sales that I'm regularly making. Then you have the up-to-date monthly undervalued stocks, which I'm updating now for the month of February. I've already shared with January. And then you've got a Discord access to, basically, that has a lot of wonderful brothers who are sharing very good practices. And then of course, if you are into basically looking at dividend trackers for UK, US and ETF trackers and so on, then you can get access to all of that, inshallah. Worst case scenario, if you can join us on the support for my channel part, that will also give you access to a lot of the things that I mentioned in here. Okay, so let's get started and look at this ETF. Like I said, the ETF we're focusing today is SCHD. And the first company we're looking at today is Texas Instrument. I think it was part of yesterday's basically video, and is basically both an ETF have this company. One of the things that we talked about yesterday, the fact that is actually dividends really good, but the expense, the payout ratio is over 100%, which is absolutely ridiculous. That means a lot of the money that their net income is actually going towards this payout ratio here, or the dividends if you like. But the latest increase was 5%, the 5-year growth rate of 10%, and the dividend streak of 21 years. So another 4 years, they will become a dividend aristocrat. Aristocrats are companies that have increased that dividend over 25 years. Dividend kings have increased it over 50 years. So annually you get $5.44, dividend safety of 80%. So this, despite being having a higher payout ratio, dividend safety is 80%. Profit margin, return equity, return investor capital, really good. and they basically have $1.5 billion of free cash flow, 15% into basically the total return in the last 10 years, 32% when it comes to EPS, expected to grow by 32%, revenue about 14%, fairly valued right now. So that's first is Texas Instrument. Another one that was on yesterday's list, I believe, is Home Depot. Home Depot is probably one of the best companies out there. I think it's going to rebound. Hasn't done well over the last year, but as you can see, for 15 years of increase in that dividend, what you get here, okay, basically this ETF, by the way, just to quickly show you, it has a dividends, but in terms of the market cap, it has all total net assets, for example, is $69 billion almost, and that's the expense ratio. Now when it comes to the dividend yield, you'll be surprised, that's 3.63, so it's slightly higher than the other one. And a lot of these companies you will see basically have a higher dividend yields. Okay, so this one is 2.3, this one is almost 3%, and as you can see here, 60% when it comes to the payout ratio, which is fine. The latest increase was over 7%, almost 8%. The 5-year growth rate 14%, and annually you get $9, 87% when it comes to the safety, and they have over $16.6 billion of free cash flow. Total return the last 10 years, we're looking at about 16%. EPS is expected to grow, and revenue, both of them about 4%. So it's slightly expensive right now, like I've always said to you guys. Right, the next one, I don't want to make the video any longer, so I'm going to speed through it, so bear with me. Okay, so next one is AbbVie, another pharma company, and we have the white mode. Currently has almost a 4% dividend yield. The payout ratio is only 58%, which is decent. Latest increase was 6%, the 5-year growth rate of 9%, 52 years of increase in that dividend. $6.56 is what you will get for every share of this company you own. Safety 80%, profit margin 90%. By the way, I'm going to share also, as always, the Shariah compliance side of things at the end of the video. Total basic return on equity 56%, return on invested capital of 22%. So really good when it comes to that side of things. Free cash flow, $15.6 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 13%. And they're expecting the earnings to grow about 14%, revenue to grow about 6%. Fairly value right now, $176 per share is where they think the price should be. Another company that has a higher dividend yield, you can see the reason why that ETF has a over 3% dividend yield, because look at this one, 5% almost. That's UPS, another company that I own. Very high payout ratio right now. Little bit concerned, however, they do have a over $4 billion of free cash flow. This is safety side of it is 67%, so I have nothing to worry about in terms of that. And they're expecting the earnings to grow about 17%, revenue to grow about 4%, is discounted about 8% right now. $145 per share is where they think the price should be. So overall, another good, decent company. Very high, not very high, but it's slightly higher dividend yield in comparison to some of the stocks that we saw yesterday. The next one is also has a closer to 3% dividend yield, and that is EOG Resources, which is another company that I own in my portfolio. Almost 3%, like I said, 30% payout ratio. Latest increase was 7%. The 5-year growth of 33%. But for the last 6 years, that's basically, they've only started paying it as the last 6 years, which is absolutely fine. Annually you get, or increasing it the last 6 years, annually you got $3.90. Safety is 82%. Profit margin, return on equity, return on invested capital, probably one of the best companies out there when it comes to oil side of things. $5.9 billion of free cash flow. Total return the last 10 years 6%. They're expecting the earnings basically to decline about 2%, revenue to grow about 2%. Fairly value right now, $126 per share. Right now is about $130 per share. We're almost there. Next one is Fastenal, which is I believe is an industrial company. 43 billion market cap, wide mode. Right now it has a 2.28% dividend yield. So another one that has over 2%. This will tell you, if you were trying to build a portfolio that has over 2-3%, you really need to average out over 2.5% to basically more than that to have a overall, like each stock to have an overall portfolio that has a over 3-4%. Which is basically kind of common sense, I guess. 76% in terms of payout ratio, so it's slightly high Okay, latest increase was 10% and the 5-year growth rate of 12%. 26 years of increase in that dividend. So another dividend aristocrat, 1.7 or $1.72 is what you get. 82% when it comes, 81% when it comes to the dividend safety, profit margin, return on equity, and return on investor capital. Absolutely fine. Less than $1 billion of free cash flow right now. Total return in the last 10 years, we're looking at about 14%. EPS growth of 9%. Revenue growth of 8%. 40% premium right now. $54 per share is where they think the price should be. Right now we're looking at about 75. So very, very expensive one. The next one is Kimberly-Clark. Look at this, 3.8% when it comes to that dividend yield. 66% payout ratio. We normally say 61 and above. And below, sorry, is safe. Above is actually not safe. Okay, very safe. You basically need safe or very safe, according to Simply Safe Dividend, in order to be able to actually the company to stay in it. However, look at the dividend safety, 88%. So that's still okay, but of course, they do have $2.9 billion of free cash flow, and the latest increase was only 3% for the last 5 years, 51 years. So another dividend king here, $4.88 is what you get. This side of things, profitability and management effectiveness is absolutely fine. Nothing wrong with that. The total return in basically was the last 10 years was about 4%. EPS expected to grow about 3%. Revenue to decline about 1%. Fairly value right now, $141 per share. The next one is Hershey Company. So another company that I have in my portfolio, and as you can see here, 3.64. This is the highest this company have had in terms of dividend side of things. It's always been basically quite expensive and so on, but this year it has down a lot for the last 18 months or so because the cocoa prices have not been the greatest. It's been too expensive, so this company's margins kind of being squashed a little bit. So yeah, we'll see what happens with that price. I genuinely believe this company is in a good place. It will bounce back at some point, but right now it's very good advantage for me anyway, long-term investor. I'm still buying it. I just shared with the community yesterday that I've actually bought more of the company, so inshallah I will continue doing that. I'll let you guys know. 61% in terms of the payout ratio, 15% latest increase, 10% when it comes to the 5-year growth rate, 14 years of increase in that dividend, $5.48 is what you'll get. I love the fact that this company is double-digit growth for the last 5 years, which is absolutely amazing, and it's very safe. They do have $1.6 billion of free cash flow. Remember, the market cap is only $30 billion. And in terms of profitability and all of that stuff, what management doing is absolutely amazing. They have returned about 5% over the last 10 years as a total return. They expected the earnings to decline about 17%, but that again depends on whether the cocoa prices changes. That can easily basically change. But for this year, they're expecting that to happen. Potentially, it might happen and give us a great opportunity. Revenue is expected to grow about 2% and 28% is discounted right now. $210 per share is where they think the price should be. The next one, it's Wasco. This is a company that we've discussed recently. 18 billion market cap, 2.2% when it comes to that dividend yield, 80% when it comes to that payout ratio. So very high. The latest increase was good, was 10%, 12% when it comes to the 5-year growth rate, 10 years of increase in it, and $10.80 is what you get. 70% safety. Profit margin is okay, it's not great, and return on equity about 20%, return on invested capital 20%, 66 million in terms of free cash flow right now, 18% total return in the last 10 years. EPS expected to grow about 12%, and revenues expected to grow about 6%, and 52% premium right now. Very expensive. $325 per share is where they think the price should be. And the last company today is Skywalk Solutions. This is probably one of the darlings of 2020, when basically a lot of the companies were going to the moon, and this company was actually one of the benefits is they are a semiconductor company, but they haven't done well since then. The price has been around here for a very long time, but look at the dividend yield right now, over 3%. Payout ratio 44%. Latest increase was 3%. The 5-year growth of 12%. 10 years of increase in that dividend, $2.82 cents is what you get. Safety 6 to 8%, which is fine. Profitability side of it is okay. $1.6 billion of free cash flow. Total return is not the greatest. EPS expected to grow about 18%, 9% when it comes to the revenue side of it. Fairly valued $95 per share is where they think the price should be. Right now it's about 88. So that's the 10 companies. I'm going to show you the Shariah compliance side of things now. So you can have a look at that. Pause the video, have a look at it. This comes from Zoya, Shariah compliant. They use these standards, and I do actually use them a lot. I have no affiliation or anything whatsoever, never reached out to them or anything like that. Never reached out to me. Well, actually they probably did at the beginning when I started, but there you have it. So that is the Shariah compliance side of things. Now what I'm going to show you will blow your mind, okay, because this is the beauty, right? What I put all the companies in here. We just basically said 2000, if I invested 10,000 US dollars in 2000 and basically hold the entire that ETF for 24 years, almost 25 years, right? And we have not basically basically added one more penny to the overall. We just left as it is, but we just reinvested our dividends. So these are all the 10 companies, 10% each. If I press this button and scroll down, we will have, I'm not going to reveal what we saw last year, so go and watch that video, have a look at that. $54,000 for 24 years. That's about 15% CAGR. That's okay, not in comparison to what we've seen last year. Now the surprising part, the most surprising thing I found today was if we contribute fixed amount every single month of 1,000 US dollars every single month, right? Inflation adjusted and so on, and we reinvest in dividends, everything else stays the same. So we're adding for 24 years, we're adding 1,000 every single month, and this is the ETF that we hold for that period of time, right? We will right now have over basically closer to 400,000 US dollars. That is very, very disappointing in comparison to what we've seen last night. However, that's basically compound annual growth rate of 35%. Now, this ETF is not as good as I actually thought. And of course, some of these companies have been, changed whatever over the last years. But again, some of these companies have not done well. Like basically some of the oil companies and so on have not actually performed to the best of their ability, whatever. And the other one, I think it had maybe a little bit more tech heavy companies that have done really well over the last years. If you want to go and watch that video, I'm not going to spoil it for you, so go watch that one. But a little bit disappointing in comparison when it comes to the total for the final balance that you would have. This one is just over 400,000, which is, by the way, is absolutely amazing. You just buy and hold every single month that you leave it, and over 400,000 is not bad. But for 24 years, that's very, very, very long time, okay, just to get that sort of a return. Now this does not, so we reinvest, and remember, this includes also the dividends that we've got and reinvest in that, all of that stuff. So yeah, there you have it. That's the basically ETF I want to share with you guys. Go and watch the other one if you have time for it, inshallah. I think you will be surprised at the difference. The portfolio is doing well okay today in comparison to yesterday, where everything was in the red. Again, I think a lot of the companies are in the red again. We've got the same companies in the red again. But anyway, who cares? It gives us an opportunity. I will be buying some stocks this week, inshallah. I will share that with you guys. I hope you're enjoying this type of content. It takes a lot of time and effort, like I've said to you guys. If you can help us and join us at the Patreon account, that will be absolutely wonderful. Have a wonderful day. Assalamu Alaikum.